Today, folks, I've started investing my stock market emergency fund because I can't help but recognize that there are some substantial deals out there with stocks that I absolutely love. Now, I've also taken my tax refund, added it to my RRSP because I finished my taxes. I got a bit more RRSP contribution room, at which I actually started investing in a global market ETF to start basically building out wealth preservation. Is the wife and I, our combined accounts are primarily just focused on growth stocks, with some exception to some dividend ETFs, as many of you know, like SCHD and VDY, but I am looking to start building out that preservation part of the portfolio. Now, I want to break all of this down and so much more. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe button, because from peak to trough right now, from the peak basically year to date, the S&P is down about 9.78%. My stock market emergency fund is there for when the market dips by 10% or more, at which I start doubling up basically my monthly contributions to VOO. But in the meantime, it's really not dipping all that much. It's kind of these geopolitical events globally, what's going on right now, that is stirring up this kind of recession fear again. Though I think a lot of stocks are heavily resilient, the S&P is still relatively overvalued, and we're not quite in correction territory just yet. So I'm still patiently awaiting. I'll still keep cost averaging here, but I am looking at other aspects of the portfolio. And right now, XEQT is something I've told you guys I want to start getting into as a bigger position. Now, I'm not selling stocks to buy this. It's just something I want to see scale over time into the future, because it is a very great ETF for me personally, and I want to break it down first and foremost. But what I also plan on doing is, as I've told you, I'm taking a speculative bet this year on Take-Two Interactive. I've got over $30,000 sitting in this stock, and it's basically the company that is the parent of GTA 6. And when that video game releases, I think there's under guidance going on between analysts and even the company themselves. The company's guiding to do $5 billion in revenue this year, which is basically what they did last year. And honestly, analysts think GTA 6 over 12 months is going to generate somewhere between like 3 and 4 billion conservatively. But I'm estimating GTA 6 will sell between 50 and 100 million copies. It's going to add an extra 5 to 10 billion to revenue this year alone, on top of the 5 billion they're guiding for. So I'm speculating that they're going to do basically double to triple what's being anticipated, which should add hopefully another 30 to 60 billion to the market cap, hopefully over doubling my money, at which I will start selling out of this by the end of this year to start putting it into XEQT. That's kind of like my trade-off with some of my speculative plays. And regardless whether that works out or not, that money that is sitting there will be allocated mostly toward this ETF to continue to build up that wealth preservation aspect of my portfolio. So XEQT, for those that are unaware, is a global market ETF, because I do want to start expanding my global market exposure, as right now I'm primarily exposed to the US and Canada. And a lot of people are shocked because somehow XEQT has been able to grow the dividend over 5 years by 21.37%. That is like the growth rate is insane. I don't know how they're achieving this kind of a growth rate. If we take a look at the dividend history here, we can actually see quite an accelerated rate. Now, if we take a look at the dividend yield and kind of some of the facts around this ETF, if you invested 10,000 when this ETF launched back in 2019, so just over 5 years ago, you've almost doubled your money. I mean, it's up to 18,865 as of today since the launch of this ETF, with a starting 12-month trailing yield of around 2%. Don't trust the distribution yield as of now, because usually the distribution yield is calculated off the last dividend, but because the quarterly payments fluctuate so drastically based off companies' payouts, the 12-month trailing is more accurate. And I'm very happy with that sweet spot of 2%. As I told you guys, by the time I do some adjustments and finish my trades up for the year, my overall dividend goal is to get around 3% on the entirety of my portfolio. And I'll do a full portfolio update on Friday that you guys can subscribe for as well. But I think I can get there quite easily with VDY, SCHD pairing to the S&P, some of our individual stocks along with this ETF as we start to scale it over time. The expense ratio falls right in line with where I'm comfortable at 0.2. I said I really don't like buying ETFs at all that cost anywhere over 0.2% and a management fee. And you might be asking yourself, like, why are you buying this global ETF over, say, something like VT, for example? And I'm going to show you right now, because I have such substantial exposure to Canada and the US already. This ETF is kind of like a one-stop shop for most people, and it's what I recommend for most people that are looking to globally diversify their portfolio, but concentrate, the more growth-oriented markets. But we can see 43% of this ETF sits in United States, 24% Canada, 6% Japan, and then there's some weightings in these other countries here. Now, VT, as an example, does have a lower expense ratio, but it has a higher rated exposure to the United States at 64.7%. Now, VT is purely a market cap global weighted ETF. So when you look at the holdings, you will see probably some higher weightings in other foreign companies like Taiwan Semiconductors, because this ETF is agnostic to basically, where the company operates out of. It just purely looks at the market cap and weights it based off its total position sizing against global market stocks. So we don't get that same position sizing here, but we do get more global market exposure with less weighting to the United States, which fits more comfortably considering the overweight I have in the US already with, the crazy amount of money I have sitting in the S&P 500's VOO. But if we take a look at the actual holdings in here, just to give you an idea of what they look like, with first and foremost ITOT being a US S&P 500 total market ETF, mostly weighting those upper stocks. I mean, obviously Apple, Nvidia, all the stocks we know and love. Second in line there is XEF. XEF is, again, basically another, global index here. I think it's more or less focused on the European market with ASML, Nestle, getting some of those stocks that I do love, that I do talk about being great buying opportunities today. XIC, sorry, the Canadian market one, a very similar, not as similar as VDY, but it basically just looks at the entire S&P TSX. And if you compare the performance of XIC to VDY, they're almost exactly the same. And I prefer VDY over XIC because I like the dividend holdings better than I do with Shopify and some of the Canadian tech companies. But this ETF will give me exposure to some of those stocks I don't have exposure to. Now, we also have finally here, because there's the S&P 500's XUS, but we're going to look at XEC, the last one in here, which is the emerging market, where you're going to get your Taiwan, Tencent, Alibaba, and some of those Chinese stocks that are much smaller weighted, but nonetheless do give me some of those Chinese exposure without me having to directly go out and buy those stocks. Like I said, my goal here is to continue to build out a market portfolio that really is for wealth preservation, as I still continue to focus on growth. In my 30s, it's more appropriate, I think, to have the position sizing I do in some of the companies I have. But as I get, later into my 30s, I do want to see, this ETF, XEQT, become a much more substantial position. But in the meantime, obviously, I'm still focused on growth stocks, and Google is one of these stocks that I'm pairing with Meta to be one of the long-term primary positions in our portfolio, because I think a decade out from now, Google has some of the most opportune, things ahead of it business-wise to scale this into a massive. I think this could easily be a $4 to $6 trillion company in the next decade. I think people are underplaying it. Its forward PE is insane. It's the cheapest S&P top 10 tech company to buy today if you're looking at individual tech from a valuation standpoint. And I've noticed that even dividend investors like PPCE and more foundational, traditional investors are even looking at this stock, saying it's a great buy. And I think a lot of people are waking up to that reality. Now, don't get me wrong, there's a lot of risk with Google I want to talk about, but right now, when you look at that risk versus the balance sheet, it's quite astounding. I mean, I can't get over the growth that this company has experienced. I mean, from 307 billion to 350 billion in revenue is, just nuts. It's a 14% double-digit growth rate. Net income has exploded from 73 billion to 100 billion on the 12-month for the entire year, year over year from 2023 to 2024. I mean, these numbers are disgusting. Absolutely disgusting. So why does the company trade at such a discounted value? Could it be a bit of the AI discussions, which I told you I sold Google just to wait to see how ChatGPT could affect the search results of people utilizing Google. Now, their search dominance has gone down a bit, but it has not stopped them from being an absolute behemoth in the space. So outside of that, we should talk about the lawsuits here, which I've been Googling around on to see where we currently sit. And I want to read to you basically where we sit with the monopoly fines that they're facing, that we should start seeing some more clarity on through April. And a lot of people are concerned by this, but they shouldn't be, because they're not really going to do a whole lot. They're looking to break Google's businesses up. But here's the reality of it. If they do break those businesses up independently, they will be worth more than they are right now under Google's, umbrella. So we do not lose that ownership. A lot of times these companies might have to spin those businesses off, at which we would just get paid out in shares, which I'm fine with either way. And even regardless if they do get a fine, which they are facing fines and penalties in other countries for monopolistic behavior, this company has so much money on their balance sheet. It is absolutely disgusting as well. I think Berkshire Hathaway is the second company in line to having the largest cash position outside of Google, because Google's cash position, their total, basically, if we just look at current assets, so cash, marketable securities, cash and cash equivalents, sit at $95 billion. I mean, their total current assets are 163 billion if you take into accounts receivable and everything else. 163 billion dollars. Berkshire is sitting at something like what, 300 billion in cash. There's no other company that comes this close to the absolute absurd amount of assets at 450 billion with only total liabilities of 125 billion. They have enough cash and cash equivalents to pay off all their liabilities, all of their liabilities, and still have an absurd amount of cash left over. I mean, we're talking probably somewhere about 40 billion in cash left over, which is just, it's insane. It's absolutely insane. But if we read through this, so what happened in a court filing on Friday, the Justice Department reaffirmed its call on Google to divest Chrome and end the exclusive search engine deal with Apple. Basically, I doubt that's going to happen. Google's illegal conduct has created an economic Goliath, one of which, wreaks havoc over marketplaces to ensure that no matter what course, Google always wins. And I don't think that's actually the case, but the push follows a landmark ruling by Judge Mitt last year, which found that Google's illegally maintained a monopoly by paying billions to remain the default search engine on the popular browser and device. And I think this is also a joke, because if Google, if you didn't want to use Google, go use Bing, go use Yahoo. They're all garbage, right? I mean, for the most part, nobody's using other search engines, and they still shit on them relentlessly because they're just terrible. I mean, Google, and that's what they're fighting to say, right? But basically, they will preside over a 2-week hearing in April to determine how Google must comply with the ruling, potentially reshaping the future of the big tech regulation. And why it's important, the Justice Department's decision to stand in its proposal fundamentally reshapes the operations of the $2 trillion company, marks one of the first clear indications of how new the administration may approach tech regulation. The proposed remedies, among most significant in the tech monopoly case since the DOJ sought to break up Microsoft in 2000, could offer insight on how President Trump appointees will handle the series of high-stakes antitrust battles against Silicon Valley's biggest players. And honestly, with the new administration, I think they'll more play into Google's dominance because, again, the competitors just suck. The Justice Department has already taken legal action against Google over its dominance in the digital advertising, with a ruling still pending. It has also filed a lawsuit against Apple, arguing that the company's tightly integrated ecosystem makes it difficult for consumers to switch to rival product. I mean, again, they're going after all these companies, including Meta, right? Like they're looking at Meta, they're looking at Apple. This isn't just a Google specific thing. And again, I think people are understating the effect it's going to have on its market cap, because these are kind of fines that aren't like actual, just a one-time pay and done. Sometimes it could be to split the company up a bit. But again, you're in a better position. Like if Apple had to split up even their AirPod business that does something like 30 billion in revenue, like that would be big enough to be an S&P 500 company, just like many of Google's businesses, that I think would only bolster our returns. So I don't even think it's a bad thing per se, but I think it's over exaggerated into the stock price as of today. So that's kind of where Google sits. And outside of that, guys, I picked up some more shares today because of why not? How could you say no to the current valuation on Google? It's absolutely disgusting. But these are the positions that I'm making, and I'd love to know what you're doing in this current market environment. I know it's a tough market environment, but you can't stop buying here. I know people are like, oh, it's going to keep dropping, and I always bring on further drops, but always be buying, baby.